In Chapter 11, we're going to shift gears again and look at the combination of international and our beginning chapters of consolidation and the situation where a parent company actually owns a foreign subsidiary. When that happens, as you've seen in your reading and our discussions, there has to be a shift into the dollars if we're a U.S. parent, and that happens either through translation or remeasurement. And the criteria for that, again, are talked about in the text and the discussion. This example, problem 8, we're going to look at translation. Translation, remember, has no immediate cash flow impact. We're just restating the financial statements, and therefore the adjustments are part of other comprehensive income, not an immediate change to net income. And we do this using the current rates as our exchange rates for translation. So you'll see I have the trial balance of our subsidiary in its foreign currency, and I need to convert it to dollars. And the exchange rate then for translation, as I said, is going to be based on the current amount. So for the balance sheet, our exchange rate is the ending spot rate at the balance sheet date, other than for equity. Equity we have to look at separately. Equity dates back to the original investment, and to make it equate on the worksheet, we have to do it at its historical rate, or the rate on the date of acquisition, which in this case was July of 2015, and so we're going to use the 55 rate. Now retained earnings we're going to have to calculate below because it's a combination of rates that accumulate over time. The income statement, because the items are assumed to happen equally throughout the year, are done at the average rate for that year. Now there's one exception in this problem, and that is the interest. As you see in the notation, that interest occurred at the end of the year. It wasn't equitably over the entire period, and therefore we do it at the end of the year. Like anything, we have to make sure that we take into account the specifics of the circumstance because each accounting situation has some unique characteristics. Now for the retained earnings piece, if we go down below, we're going to take the foreign currency amounts based on the different points in time here because we know retained earnings is a layered effect. So our balance when we acquired it was $2,520,000 in foreign currency. Well, we want to apply that historical rate there, just like we did above, and get our translated amount for that first layer. Then we know retained earnings is a combination of income and dividends. So the next layer that we need to take is the 6 months of income that was earned after the acquisition in 2015. That amounted to $2 million in foreign currency, and we're going to use the average rate for that 6 months to get the rate for translation and to calculate our dollar amount. Then 2016 was the next year, and total earnings in the foreign currency was $3 million. Average rate given in the text is 58. So that's how we get our dollar amount of $1,740,000. Then we're going to combine those because of those layers to get our ending balance for 2016, which would also be the beginning balance for 2017, and we're going to bring that up into our trial balance as a credit amount. Now you'll notice our trial balance does not balance, because if we take things that balance originally but apply all different rates, it's not going to work out mathematically. This represents the cumulative effect of how the currency has been fluctuating. We've had this subsidiary now for half of 2015, all of 16, and all of 17, so 2.5 years. And in 2.5 years, this is the cumulative effect of the translation. This has not gone through net income. It's part of other comprehensive income. We take that to make the trial balance foot to zero, and that becomes part of our worksheet as well. Now when we go down to the worksheet, you'll see that I've put the numbers in that we just calculated up above. I've already put them in the trial balance here for the subsidiary, still foots to zero. And now we're back at the same starting point we were in our earlier chapters. And we need to do our adjusting entries. Now, one of the things we haven't done is a DDE, and we don't have to do a whole DDE here, but we do need to accumulate a couple of pieces to help us with the entries. So if you look back at the text, the acquisition price was 33 million foreign currency. For that 33 million, they acquired the equity pieces that are given in the text and that sum to 30 million. So the excess created at acquisition was 3 million in foreign currency. And we're going to have to convert that depending on the timing and the situation. So this helps us keep this information off to the side. For that excess, it's all attributable to goodwill according to the text. It's going to be amortized over 10 years. So our annual amortization of that is 300,000. For 2015, when we only had it for half a year, we took a half of year, and then in 2016 we took a whole year, and then this year obviously we'll have to take another year. So that information will just help us get the entries recorded. So now again, back to the same format we did earlier. We start with the CY1 entry, and the CY1 entry comes right from the trial balance, as you recall, with what was recorded by the parent under the simple equity method. The EL entry, again, comes right from the trial balance. These are the translated amounts and why we use the historical amounts up above so that it translates out at what we acquired it for against the investment. And a retained earnings piece. And so then our adjustment to the investment is the combination of those three pieces. That one doesn't have any impact because we translated it at historical and at what we've recorded in the investment. Now the D entry though does have an impact for translation adjustment because the equipment, if we had recorded the actual step up in value on the subsidiary's books, would have been translated. This 3 million in foreign currency excess would have been translated along with the balance sheet above at the 65 rate, the end of the year spot rate. So that's the rate we're going to put into the equipment account to keep everything equal. But for the investment, this excess was back at the rate when we acquired it at the historical rate, and that equated to the 55 rate. So the difference, the 300,000, the difference between these two, becomes an additional part of our cumulative translation adjustment. So that's the only difference so far is this. Now you'll see that we also have that happening in the A entry. So the D and the A entry are the only ones impacted by it being a foreign subsidiary. Once you get to the worksheet, you have to adjust for cumulative translation adjustments for D and A. Other than that, you're going to do the eliminations on the worksheet exactly in the same manner as we did earlier. So expense. Well, expense for the current year, 300,000 foreign currency. It's an income statement item. As an income statement item, we take it at the average, just like we did above. So that's what we're going to record for expense. Now, in the prior years, we had expense. Remember, with a worksheet, we don't have the benefit of a general ledger that rolls forward, so we have to account for prior periods. The amortization that we took in 2015 needs to be done at the average rate that was applicable for that period. And then we also need to take the 2016 amortization at its average to get our retained earnings representing those prior 2 years of expense. Our accumulated is going to be a combination of 2015, 2016, and what we took for this year. And accumulated again is back to the balance sheet. So it's going to be at our ending spot rate that we use to translate the balance sheet of 65. So that's how we end up with the differences there. And if we then calculate the translation adjustment, it's the difference between what we recorded, in this case 27,000. And that's the only impact of having a foreign subsidiary, is that cumulative translation adjustment on D and A. The other two entries here relate back to Chapter 4 and having an intercompany payable receivable and corresponding interest. So they're simply eliminated against each other, and the amounts come directly from the trial balance. So there's all our entries. Now I'll pause for a minute to put these into the worksheet, and then we'll come back and look at the finished product. Okay, after I've loaded the entries, we see that they balance. Then I need to complete my worksheet just like I did earlier. In this case, it's 100% acquisition, so I don't have to worry about an NCI column. So I'm going to carry my balance sheet directly over to the balance sheet. Couple of adjustments here. We need to adjust for, remember, the formula for the investment, since there's some adjustments that don't all fit on a single line coming across. And I'm also going to need to adjust my retained earnings because I have one adjustment that did not fit on the same line going across. So that should be my consolidated balance sheet prior to closing out the income statement. Now the income statement piece then will be this portion carried across to the income statement, and we don't have any formula adjustments to do because everything was on a single line. And then what I'm left with, notice that the interest income, interest expense zeroed out like it should, subsidiary income zeroed out. I'm left with my cumulative translation adjustment, which I'm going to carry across to the balance sheet, because remember that's part of OCI, not net income, and therefore it's reported generally in equity, and we carry that across. So now we're ready to sum our totals. So consolidated income is 18 million, and we carry that across to the balance sheet because that's where we close out income. We close it out to retained earnings, and we sum our column in our balance sheet foots to 0 because debits should equal credits, and we've completed problem 8.